I mean, in coded language, is Jay Powell kind of suggesting that interest rate hikes could come sooner than the market expects?
Morning, Brian. Yeah, I think the market's catching on to that, as you say. He puts in that testimony this word enduring, right? It lasts longer, these bottlenecks, and the market is connecting those bottlenecks with the pressures that we're seeing in energy, and that leads to inflation. So that should translate then over time into rate hikes. So the yield on the Treasury this morning at 153 is not really the number we're going to be sitting at for a while. No, we're going to likely move higher because, if anything, it's also correlated with what's going on in Europe, where, for example, in the UK, as you outlined in the segment, their gas line, big lines for gas stations where it leads to shortages and UK inflation goes up. So UK rates move up much faster now, and they're ready to hike. So I think this is this picture here. Rates are catching on to, we're going to have to accept that inflation is higher and stickier, and this will be a key part of this testimony.
Yeah, and we're going to get a live report, by the way, on that gasoline problem in the UK in moments, Ben. But like, the market is like kids at a party with a piñata. Someone hits the piñata, the candy falls out. No one wants to be the last kid to get the candy. You get all the worst stuff. The bond market is already moving, is it not? I mean, the bond market anticipating higher rates, that explains, I think, tell me if I'm wrong, the big shift we have seen in not only rates, but also, maybe we can throw them up, one of the reasons why the NASDAQ futures are down 1.5%, double the nominal value of the Dow futures right now. That is a yield curve move.
That is definitely a yield curve move, and I think it's two things about that. It is higher rates, and technology shares is what people mostly say that are long duration assets, because tech shares don't pay any dividend or not as much, so they're sensitive to rates. But then there's also, I think, an ongoing rotation. People do realize that this is not a weak economy. We have inflation, but we have also a lot of demand out there. So you're going to get, again, a rotation here. And I noted that industrials or energy or financials are typically do really well in a rising rate environment. Technology or utilities do not. So I think this rotation will continue and detract from technology and benefit the industrials as rates go up. So it's also a positive economic story, I think. But for technology today, It will probably be a tough day given where rates are.
We've kind of got a triple play of crises going on right now. And I know the media overuses the term crisis all the time. It's become almost had no meaning, Ben. But I think you get my point, which is in the short term, you've got the debt ceiling fight and some of the congressional issues there, potential government shutdown, unlikely to happen, but it's still hanging out there. In a longer term, forget about gasoline, the natural gas and potential energy crisis in Europe, and I use that word rightly because we could have blackouts and brownouts this winter, people unable to heat their homes. And the third part would be that's already occurring in China. We are seeing rolling blackouts because they simply don't have the power to power their entire economy. This is kind of a three-headed hydra, if you will, of uncertainty and volatility happening right now.
Yeah, it's like a trifecta, right? It's just all merging together. And it was not foreseen, really. And I think a month ago or so, some pressures building, but I think nobody really foresaw that as China put already curbs on its electricity use for carbon emission, and Europe faces these dry spell in inventory, really low gas inventories, particularly coming out of Russia and also out of Asia, with a lot of demand for gas on top. Yeah, we're merging into a situation where the spike in gas is really leading. That leads to higher crude prices. You get some what they call fuel switching, so some product switching. But for the broad markets, it means simply, look, interest rates are going to have to reflect this higher energy component because it does push up inflation. And at the same time, it's also a function of the economy. Again, also Europe is not a weak economy at the moment. So it's all about party of strength and a wall of worry here this morning.